Welcome back to the course Introduction to Commercial Banking and FinTech. In this course, we will try to understand. In the last session, we were focusing on monetary policy transmission and different channels, and we were able to understand that how those channels are important and how those channels spread in the economy when central bank changes the rate of interest. So monetary policy transmission under different channels like cash flow and price channel, we have to also think about how we can go about finding the gist of those channels. So in that respect, we are going to first cover the balance sheet side of it, which I have given the title Understanding the Financial Accounting of a Bank. Why this is important? Because when we discuss cash flow, at that time we'll be using net income and shareholders equity and other variables. So I thought it will be good that when we are covering balance sheet, then we can touch upon those variables and topics, and then we can get back to monetary policy transmission again. So this is one of the important topics in the commercial banking domain, and one has to understand a bit of it, because when we go into regulations, then these variables will be coming again and again, and it will be good that we can cover these topics in the beginning, so that it will be easier for us to understand those regulations easily. So in terms of books, I have already mentioned Mishkin. You can also refer to some of the documents available on the RBI. They also you also have the circulars issued by RBI. So those documents are equally important. But Economics of Money, Banking and Financial Markets by Mishkin, Frederick Mishkin, is the core textbook. You can also read from Boddy. Boddy also has a good amount of I'm talking about Boddy, Kane and Marcus. So there also you have the book Investments, and investments cover a bit of the banking, and it is also equally important. Now, so let's go about balance sheet. What it covers? So basically, here you have the income statement. So we can also touch upon we can also go about what we call it as the income statement. So there we mention about the profit and loss, right? In balance sheet, in whether you cover the financial companies or non-financial companies, you can consider that as an assets and liabilities, right? Here we think about cost, revenue, sales, right, and fixed and variable cost. And some of the items not items you can say specific to the banking, right? So in this particular session we'll be touching upon this. Here we have the assets. So assets includes what? So assets, you have the liabilities plus equity, but in the case of banking, here you have the assets. So assets are normally the loans, which also becomes the liabilities, and but in liability, banks normally consider the deposits, the money that you deposit in the bank. This is the liability, because this becomes a burden for the bank to offer rate of interest. So this deposit that you keep in the bank in the form of fixed deposit, it accumulates a rate of interest, so it has to be borne by the bank, and bank has to pay on this. The loan that they disburse, it has higher rate than the deposits, and the earnings on this become the asset. So in majority of the cases, we say that we in the case of banking, we often use the term called NPA, which is nothing but the non-performing assets, right? So this is what we get. Now let's go one by one. What do we have in the case of a bank asset? So one is the cash and due from the bank. So whatever, so interbank borrowing and lending happen, and in that they often transfer the cash and the due. So within, suppose SBI is giving money to the and cash and due to the PNB, Punjab National Bank. So whatever is the outstanding amount, that becomes the asset, because on that they may be earning some rate of interest. Second is the investment. So government also prioritizes these banks to invest in certain fixed income securities. So in India, the government bond market, which is the fixed income market, so which is, we call it as gilt edged securities market, right? So investments normally in this case fixed income securities, so they also earn rate of interest, because if the banks are investing in these instruments, so they will be getting some rate of interest, that we know through reverse repo, right? If you remember, we discussed about reverse repo. So if the banks are going to keep money in with the RBI, so they have to also have the collateral. Then they also have some kind of income coming from the different sources. For example, if they have gone for leasing or any other asset, so that will be part of. Loan represents the major portion. So if you think about the asset size, so if the bank has more asset size coming from the loans, then it is called as good for the bank. So loans represent the primary earning asset at most banks. Bank serves the need for their community, and then they extend, and of course this is one of the important, so what we call it as the fractional banking, the term that we often use, we call it as fractional banking, right? What is the meaning? That if you are depositing in a bank rupees 100, we will talk about. So if we are depositing in a bank rupees 100, 10 rupees is mandatory for the bank to keep in the form of CRR and SLR. So banks have how much? They are left with rupees 90, and this 90 rupees they will be now investing in some other banks, right? So they can either go and keep with the RBI, or they can lend, right? Suppose out of this they get, so one is the required reserve and then there is excess reserve. So suppose they are able to lend only 60 rupees. So 30 rupees they already they have extra amount that they are not able to lend to anyone. Then this money they can keep with RBI at SDF, or they can keep that as an excess reserves, right? Which they can later get this money back and lend to somebody, right? So this is what we have. So standing deposit facility here we have. They can also go through the reverse repo kind of situation, right? But this requires collateral of the government bond. This does not require collateral. So this is what we get here. Sorry. And other assets could be like if the banks are owning fixed assets like real estate, rentals, right, or some instruments which are not part of the governments, but they are allowed to buy or sell. So that interest on those, and they might be owning some foreign bonds, on that they will be getting some rate of interest. So that is what other real estate, for example, in Mumbai you will find that majority of the buildings may have some share of SBI or any any government bank, just to keep their employees. So that kind of, so it also saves a lot of money. So it is also related with that. Then comes the liabilities. As I mentioned, that liabilities, the first liability comes is the demand deposits. What is? Because it is the, so banks are supposed to pay rate of interest in that, and it includes both time and saving deposits. Time means fixed deposit, right? And here we have the so whatever the rate or whatever individuals are depositing money in the bank gives two types of services. One is the check issued, another is the rate of interest earned, right? So this is what we get. Interest bearing liabilities are this. So repo rate purchases are also like overnight obligations to one bank, borrow clearing balances, reserves held with RBI. Then repurchase agreement. So repo rate when the banks are going to borrow money, reverse repo when banks are going to lend. So this also requires the transfer of collateral, and this is where the sale of securities, buy of securities, right? So when banks are buying the securities, it means that they are giving money to the RBI. When banks are selling, it means that banks are now getting more cash, so it increases the liquidity. So these two are linked with, you can say in sum, these two are linked with liquidity adjustment facility, right? So this is what we get. Then here we have the income statement. So in case of income statement, as I told, so this is related with the balance sheet. I will come back to some more details later. In income statement, here we have some more important variables, and as I mentioned that it is about the profit and losses. But in the case of non-financial companies, so the income statement of the financial and non-financial companies are different. So if you remember, I mentioned here on this particular page that it talks, so this is sales, fixed, variable and all. It deals with, we call it as non-financial. For financial income statement, for financial companies, income statement includes the interest income, non-interest income, etc. Right? So this is what we get. Now here we have the interest income equals the sum of interest earned on the earning asset. So this is what here we have. Interest expense. So it includes the sum of interest paid on transaction accounts, time and saving deposit. So this is what here we have. So interest income when we have the sum of interest earned on earning asset, and interest expense is the what we get for the, so interest income what the bank gets. So maybe you have the loans and other thing. Interest expense when you pay back, so on transaction account and saving deposits, the rate of interest that you pay. So net interest income is how much you get and how much you pay. So this is what, and then here we have the provision for loan losses. Sorry, so provision for loan losses shows how much they are going to deduct. So each year when banks are going to take decision about the balance sheet formation or next year financials, then they plan in advance that if they have the outstanding of suppose 100 crore rupees of NPAs, then how much they can eat out those. So there will be some kind of provision. So this is a provision for loan losses. So so how much they are going to have the potential losses from the default on the loan. So problem loans that I have written, it is basically talking about default on loans. So companies start making advanced provisions that these many accounts are not responsive and they have already lent the money and the borrowers are not responding. So let's keep these accounts aside and make some provision that if there will be some default, suppose there are 10 accounts, if there will be 2 default, then we'll be trying to manage or try to cover up, which means that some kind of monitoring is happening on those accounts. So this is what here we have. Non-interest income is interesting. In case of non-interest income, you get service charges. So nowadays you will find that majority of the banks are charging the service charges, then fees and commission. So if you are getting some services, suppose you are charging you are using international debit card, and international debit card has some special features, and if to utilize those features you need to pay some amount. So those things, you have the minimum account balance service. So if your account balance is less than 10,000, then there will be some penalty on you for not maintaining the minimum balance. So that then there will be something called merchant fee and others. For example, banks also offer financial services. They will be also offering some credit card services. In credit card, you have membership fee. On membership fee, you have the bonus points, with bonus point redemptions are also part of. So all those things that we get. Security sales, like for example demat accounts. So majority of the banking system nowadays, because the fintech, it is possible to invest in a stock market, and then you have the online KYC also, which has changed the landscape of financial investment. So nowadays you have the app based investments happening through Grow and your Pop Stock and other apps. But typically, in a very conventional way, if you have to invest money in the stock market, then you open a demat account with bank, and bank will be charging some commission whenever you transact, right? So this is what we have. A large bank, which we call it as the systemically important bank. So if you go on the RBI website, there is something called SIPs. So here we have the systematically important banks. Right, so SIPs are those banks which are really big in size. If something goes wrong with these banks, then there will be catastrophic impact on rest of the sectors or economies. So this way, in the case of banking, so not systematically, it is called systemically important. So here it is. Let me just correct it. It is called systemically, not systematically. So in case of banking, we use the term called systemic and not systematic. Systematic and unsystematic risk are related with the asset pricing, but I am talking about banking, and it is the failure of aggregate ecosystem. So this is called systemic, SYSTEMIC. So non-interest income becomes important. Some of the banks are also involved in forex transactions, so there will be commissions on of that, and there will be they will be participating in different financial instruments called swap and others, forward. We know interest rate parity. We saw with the foreign exchange channel of monetary policy, that how the interest rate parity play important role, and it also has a lot of role to play. So in that way, fee arises from loan commitment. So some type, when you take money from the bank, they will be charging also processing fee. So that becomes the non-interest income. You have the letter of credit issued by the bank, and letter of credit is something that you have the bank account with the bank, you have the cash, but you don't want to deal with the cash. You want to have the you may not be interested in transferring cash immediately, but you can issue the letter of credit, which will have the validity of 30 days or 60 days. So this letter of credit can be transferred from one person to another, and the person within that expiry period, whosoever is the last person to use that, will be the sole responsible for the settlement. So settlement happens with the last person using letter of credit, but letter of credit also changes the hand. So in case of Nirav Modi case, that was the case with the Bank of Baroda in Singapore. So and then you have the trust department called if banks also spend a lot of money on the different kind of charges. For example, there will be if they are offering you premium credit card, so credit card will have the telephonic services. So any transaction happen, you get the call. So those cost will be included in your annual premium payment. So these things are the non-interest income for the. In the case of income statement, we also have something called a bank's burden. Bank's burden is basically the difference between non-interest expense, how much the company is, a bank is incurring the expense, and non-interest income. So this is what we get, and you can match this because this is all related with the non-interest income expense. So you will find that sometime if we can remember, SBI also wanted to charge the minimum balance fee, but later they waived off. But still, I think in some accounts they have. So the bank's burden basically it is not coming from interest income; it is non-interest income. So this has to be either zero or positive, right, or negative, because income is supposed to be higher than the expense. So in majority of the cases, when they find that it is positive, not zero, then they will be putting some extra cost, right? So this is what we get. In the case of income statement, we often get what we call it as the net interest income minus the net income that you have. So for the bank, I think it will come in later slides also. So I am talking about net income. So earning before, you can say EBIT, earning before interest and taxes. So EBIT is basically net interest income, NII, minus provision for loan losses, minus burden, and burden is what? Non-interest expense minus non-interest income. So net income is then obtained by subtracting the taxes. So if you are including a earning before interest and taxes, so if you are going for adjustment of taxes, then it is classified as the net income, that now you have paid the tax and whatever is the extra, so you can say disposable kind of profit that here we have. Net interest income is basically the interest income minus interest expense. So this is what we get. So net income of a bank is nothing but net interest income minus provision for loan losses if they have any, right? In some cases it may be zero. If there are no default on any bank and there is no likelihood of becoming any account into NPAs, then loss provisions will be almost zero. And burden is basically you have the non-interest expense minus non-interest income, right? So non-interest income, if you just think about, so here we calculated the non-interest income. Here we have the non-interest expense. In non-interest expense, because income we have already discussed, so this is just the extension of that. Non-interest expense, we have nothing but what we get as the salaries of the employees, so and bonuses what banks give to their employees, pensions which they promise, training which they give to the employees, recruitment cost, many times when they hire bank POs and others, so they often mention this, occupancy and infrastructure cost, which they you can define that in terms of rent, utilities, branch operations, technology platforms. For example, if you have SBI apps, so whatever is the technology support coming from different sources, so technology platform, data center maintenance, which has become all the KYC related data is linked with that, equipment and administrative expense, so this is also related with that, so this we can touch upon. And then here the IT hardware, software, any kind of cyber security kind of equipment that they borrow, invest. Legal and consultancy fee, for example, banks may also be having some kind of default or some kind of litigation cases with customers on loaning and other stuff, so that we often include. Advertising, professional services, so this we also include. Insurance, then we have the fraud, loss provision. So here a whole lot of expenses that banks incur, that they include that as a non-interest expense. So when you calculate the burden of the bank, so it is non-interest expense minus non-interest income. So in this way it becomes really important. So if I have to calculate my net interest income, so just to summarize what we have covered so far, interest income minus interest expense. So this burden is what? Non-interest expense minus non-interest income. So OI, and here we have the net income. So net interest income is nothing but here we have the provision for loan losses and burden, and after tax net income, pre-tax net income minus the taxes. So this is what we get. Let's have one example before we close this particular session. So suppose we know that all the commercial banks make investment through this. So this is the context I have given. I am giving you the data. For example, we have the interest income of a bank 1080, everything is given in crores. Interest expense is 720, non-interest income is 180, non-interest expense is 240, provision for loan losses in 90, and then here we have no taxes as of now, right? So earning before interest and taxes, so taxes we are not including. What you have to calculate is the net income, then here we have the burden, and then we have the pre-tax net income. This we have to calculate. So we know that net interest income is just 1080 minus 720, non-interest expense, so 240 minus 180 becomes the burden. Pre-tax, so if you just subtract net income, what we get here, minus provision 90 minus what is, then we get the net income. So this is what we have. So interest income minus interest expense. So 1000 minus 720, 360 crore is your net interest income. Then here we have the burden. Burden is what? Net interest expense minus net interest income. So it is how much? It is 60 crore. So this we get. Then here we have the pre-tax net income. So here we have 360 minus 90 minus 60. So it is 210 crores, right? This is we get. So which means that if you think in terms of net income, bank is still making profit, but it is eaten, 150 crore is eaten by the burden and also the pre-tax and also the provision. So provision is 90, and then here we have the burden is 60. So these two are the extra expense that the bank is incurring, and we can see that the net income that the bank earned 360 crore, 150 is being subtracted. So 210 crore is the net income. I hope with this example you are able to get familiarized with the key concepts in the banking system. If tomorrow after doing this course, if somebody asks you that how do you calculate the net income of a bank, right? So then you can easily say, if they ask you that calculate the pre-tax net income, and they give you the tax figure also, and after that you can just subtract, right? So this is what is the main purpose of doing this course. And while attending all these lectures, I would request all of you that you can also create the similar question for your practice. I will be of course uploading the practice set, but this understanding will help you a lot. And especially if you are working in the banking domain, then such understanding you might be having. If you are not having, then this particular slide will be really useful. So with this, I am stopping it here. Thank you so much. I really appreciate it.